Well, I think investors are watching the entire financial sector, particularly as it relates to whether or not reserves are going to be going up, and also the consumer data. If you really think about what's happened since the economies have opened up, even with the latest restrictions, you examine credit card data and spending for some of the financials that are more exposed to those areas, particularly as it relates to leisure. It has actually picked up. Hotel bookings have picked up, mobile activities picked up, even airline traffic has picked up. But when you really get to the heart of consumer spending year over year, you're almost close, if not at the same level you were pre-pandemic. So a lot of eyes across the board. And then, of course, we get momentum names providing a little bit of tailwind perhaps with their earnings announcements second and third week after the financials.
Sure. Chris, you're talking about how the price to earnings ratio, which is a typical ratio that you follow, valuation metric to size up the market's performance, is not really a good valuation measure at this point in time. How would you value the markets and the momentum, given that we are at record high, especially for the NASDAQ?
Yeah, when you come out of a recession, the earnings level is at depressed levels, and particularly this one, which you could argue is at the most depressed levels we've seen really since the Great Depression, going back many, many decades. So the PE overall is likely to obviously be high. So what you want to do is you want to examine the quality of earnings. The first thing you look at is free cash flow. The free cash flow sectors within the S&P 500 in the U.S. that have the heaviest free cash flow is technology and healthcare. So there's no surprise that they're leading the market advance. Even some of the momentum names that may not have actual solid earnings, their free cash flow and cash on hand and solid balance sheets are what driving investors into those areas. And then the other area, quite frankly, is credit spreads have narrowed. You want to look at equity risk premiums. And that's another a longer term, but still a very good gauge coming out of recessions as to how attractive equities are relative to fixed income.